There has been an astronomical amount of speculation in EV stocks within the last 6 months, to the point where EV stocks are, well, some people claim they're in an enormous bubble. Is that true? Well, I'll leave that up to you. But I'm going to share with you a very cautionary tale. Hello, my friends. Welcome to the Electric Viking. My name is Sam Evans. Wonderful to have you here on the channel. Now, welcome to the 10,000 new subscribers that have come on board over the past week. Thank you to Sandy Munro for giving us a shout out. To all of the new subscribers, make sure you check out some of the 630 videos we've created over the last 6 months. A lot of those videos will actually educate you as to the facts that, well, obviously Tesla is not the only electric car company in the world, neither is Rivian and Lucid. There's a lot more going on and there's a lot more at stake. Now, there's quite a number of YouTube channels out right now that honestly are giving false information to people because they support one brand only or one perspective only. So what I try to do here on this channel is give you the opportunity to see that there is more out there. There's not only one viewpoint, there is many viewpoints. Now, a good friend of mine called Derek Bogart sent me this article by Andrew Hallam for Swiss Quote called When Speculation Crashes. Now, just to play a little game, I invested $10 into Rivian and $10 into Lucid. And I believe it's going to be very interesting to see how that $10 goes over the next few years. At this point, both of them have lost between 5 to 15%. Now, there was an article recently posted on Seeking Alpha. Obviously, Seeking Alpha claim that they're experts in investing money and you should read what they say and therefore do as they say. Now, in this article, the author claimed that Lucid Motors was an amazing electric car company, and for a bunch of reasons, they had invested half of their net worth into this company, which is now worth more than 70 billion US dollars, even though they've only produced a very small number of cars. Now, obviously, this author was basically saying to its audience that you should consider investing up to half of your net worth into a highly speculative company. Now, Will Ferguson doesn't remember saying it. The Canadian English teacher was living in Japan and drunk at an after-work party. But his colleagues remembered what he said, and several weeks later, they continued to bring it up. In Japan, the cherry blossoms bloom first in the south, and they remain so for about a week. If somebody began a journey on Japan's southern tip and traveled to the country's northernmost point, they could bask in the pink flowered bloom, known as sakura, for longer than a month. Ferguson, in his inebriated state, claimed he would do just that. In his book, Hitching Rides with Buddha, Ferguson describes why he decided to eventually take the trip. If he hitchhiked the entire way, he might find what he called the true heart of Japan. It might help him answer questions such as, what makes these people tick? Culturally, we're all unique. But our motivations, even if they look different, remain the same no matter what. We want, as a species, to survive. We want to live the best lives we can. We want to protect those we love. Even kamikaze pilots during World War II didn't differ all that much. Ferguson describes their last radioed words before their explosive-laden aircraft slammed into opposing ships. They didn't scream, "Long live the Emperor." Instead, they cried for their mamas. They were human, after all. We often rationalize our actions, finding support for decisions we make. Such is the case when an asset class rises faster than the law of economics says it should. We invest in things that are rising in value because we hope that they will rise further and faster, and we'll become richer as a result. And such hopes become beliefs once we have already committed our money. Sunk cost bias plays a part. This is known as the endowment effect, when something is worth even more in the eyes of an owner who just acquired it. But economic laws are like rubber bands. They stretch sometimes really far, too far, before they snap. Such was the case with Japanese stocks. They became the world's hottest tickets. After World War II, Japanese businesses began to thrive, and the prices of those stocks rose in line with business earnings until they didn't. The elastic began to stretch. From 1950 to 1960, the Nikkei 225 index of Japanese stocks measured in US dollars averaged 37.7% per year, including reinvested dividends. That was a 10-year gain of 2,340%. But Japanese businesses didn't increase their earnings by 2,340%. So the elastic just grew thinner and thinner and thinner. Over the next 20 years, the band stretched further as Japanese stock prices continued to rise far faster than business earnings did. Including reinvested dividends, Japanese stocks averaged a compound annual return of 15.9% from 1960 to 1980, a 20-year period. In other words, over that 20-year period, they gained a total of 1,800%. Once again, business earnings did not average growth even remotely close to 16% per year for 20 years. Let's put this into perspective. If somebody would have invested $1,000 in a stock index between 1950 and 1980, that money would have grown to $24,000. That was the US stock market between 1950 and 1980. That's a great return. But if $1,000 were invested in a Japanese stock index over the same time period, it would have grown from $1,000 to $462,740. That is on another planet. The PE ratio for the average Japanese stock traded above 70 times earnings in 1989. That was for the entire Japanese stock market. The Japanese stock market was the largest on the planet. Hope, greed, and belief continued to pull on the elastic band. The endowment effect grew stronger as experts rationalized prices. Over the 40 years between 1950 and 1990, Japanese stocks averaged 22% per year. That's for 40 years, including reinvested dividends. That means a $1,000 investment in Japanese stocks would have grown to $2.74 million. Yep, $1,000 would have ballooned to more than $2.7 million. Those returns attracted more investors. By the late 1980s, Japanese stocks were hotter than Bitcoin is right now. But the fundamentals to support those prices simply weren't there. That's why the elastic snapped. Those who suffered most were retail investors who jumped on late, often after seeing their friends make easy money. If someone lumped $1,000, it would have been worth just $350 3 years later. Between January 1989 and September 30, 2021, Japanese stocks gained a compound annual return of just 1.7%, including reinvested dividends. As humans, we culturally differ, but we're all still the same. We want to live well, but that can push us to be greedy. We chase rising asset classes. We often ignore fundamentals. We say, this time it's different. Whether we're talking about an individual stock, a country's stock market, real estate prices, Dutch tulip bulbs, or a cryptocurrency, the fundamental laws of economics always eventually have the final say. That's why, if you're putting your money into something that doesn't earn business or rental earnings, that's not an investment. It's speculation, and it's gambling. Cherry blossoms don't last forever, nor do soaring prices that rise much faster than fundamentals. So if you want to invest well, don't speculate. Build a globally diversified portfolio of stock and bond market index funds. But more than that, do your research. If you want to invest in just one company, that's fine. But don't just read one article somewhere or listen to one YouTube channel, take their advice, and then act on it. Do your research. Add money when you have it. Rebalance as needed back to your goal allocation. That's easier said than done. You'll always be tempted to chase seemingly easy money. I have. It's happened to me in the past, for sure. But when the plane goes down, you won't be screaming out, "Long live speculation." And my advice is, don't invest half your net worth in a company unless you know damn sure that that company will justify that valuation within at least a period of 5 years. So on that note, thanks for watching. I hope you have a fantastic day. Wonderful again to see you, and I'll see you on the next video. Bye-bye.